I bet you didn't know how many different financial instruments you can trade. Various financial instruments can be used in trading, each with unique characteristics and suitability for different strategies like scalping, swing trading, and long-term investing. Here are some common instruments for trading. Stocks are shares of ownership in a corporation, traded on stock exchanges like SGX, NYSE, and NASDAQ. They offer high liquidity and a wide variety of companies and sectors, but can be volatile and require significant capital. Forex involves trading currencies in pairs, such as EUR/USD, in a decentralized market that operates 24/5. It offers high liquidity and low transaction costs with leverage options, though it can be highly volatile and influenced by global economic factors. Futures are contracts to buy or sell an asset at a future date at a predetermined price, traded on futures exchanges like CME. They provide leverage, high liquidity, and a variety of underlying assets, but come with high risk due to leverage and significant margin requirements. Options are contracts giving the right, but not the obligation, to buy or sell an asset at a set price before a certain date, traded on options exchanges like CBOE. They offer flexibility and limited risk for buyers, but are complex and can lead to significant losses for sellers. ETFs, or exchange-traded funds, are investment funds traded on stock exchanges, holding a basket of assets. They provide diversification, liquidity, and lower fees compared to mutual funds, though they can be affected by market volatility and tracking errors. CFDs, or contracts for difference, are derivative products allowing speculation on price movements without owning the underlying asset, traded OTC. They offer leverage, the ability to go long or short, and access to various markets, but carry high risk due to leverage and are not available in all countries. Cryptocurrencies are digital or virtual currencies like Bitcoin and Ethereum using cryptography for security, traded on cryptocurrency exchanges like Binance and Coinbase. They are known for high volatility and a market that operates 24/7, but face regulatory risks and potential for fraud and hacking. Bonds are debt securities issued by governments or corporations to raise capital, traded on bond markets. They generally offer lower risk and predictable returns, but have lower returns compared to equities and face interest rate risk. Mutual funds are pooled investment funds managed by professionals, investing in a diversified portfolio, bought directly from fund companies or brokers. They offer diversification and professional management, but come with management fees and less control over individual investments. Commodities are physical goods like gold, oil, and agricultural products, traded on commodity exchanges like COMEX and NYMEX. They serve as a diversification tool and inflation hedge, but are subject to volatility and storage costs for physical commodities. Indices are statistical measures of the performance of a group of stocks, such as the S&P 500, traded via futures, ETFs, and options. They provide broad market exposure and diversified risk, but are affected by macroeconomic factors, and you cannot directly invest in an index. Choosing the right trading instrument depends on several factors, including your trading strategy, risk tolerance, capital, and market knowledge. By selecting the appropriate instruments and understanding their characteristics, you can better align your trading strategies with your financial goals and risk tolerance. Like, if you find this useful, and follow for more trading tips and insights. This is not a financial advice, but purely for informational purposes only.